I was absolutely fascinated by this. And the crazy thing, I know I probably shouldn't be talking about this on the internet, but I don't really care. The crazy thing about this is I was in the shower a couple days ago. This is a legitimate story. Everything here happened in order. So I was in the shower. I was thinking, like, obviously what I do all day, how to get more Bitcoin. And I was like, you know what? Maybe I should just propose this to the family and say, maybe we should just look into refinancing the house and buying Bitcoin, setting up a brand new multi-sig setup for this Bitcoin specifically, and just see what happens. I just think that there's way too much demand. There's way too many companies, way too many countries, way too many people who are going to be getting into Bitcoin. This thing is only going to go one way here, fast. And it might happen very fast. So then I come downstairs and Bridge is like, she's probably going to be mad I said this, but this legit happened. So we're talking about something. She's like, do you want to hear something crazy? And I was like, yeah, of course. And she's like, I was thinking maybe we should take out a loan or refinance the house to buy some more Bitcoin. And I was like, on the inside, I was like exploding with joy. Not that even if we didn't do it, the fact that she's thinking like that, the fact that she understands where this is going and is willing to, most people you talk to, if you mention that to them, they think you're out of your mind. And she proposed it. And she's like, do you think that's crazy? I'm like, I literally just thought about this like an hour ago in the shower. And then, so we talked about it. We're like, I don't know. It might not make sense right now. But then yesterday I watched this video and we're going to watch it right now. It's 5 minutes long. I'll speed it up a little bit. But this is what's happening. This is the future of lending, of collateral, of real estate, of Bitcoin, all wrapped up in 5 minutes. So we're going to watch it. We're going to talk about it. I got a little explanation that I'm going to do after on a spreadsheet. And then I'm going to talk about who this makes sense for.
Andrew, I'm so pleased to be here. And I'm really excited to announce today on Squawkbox this loan that we've just completed. We combined a seasoned multifamily asset in Philadelphia, about 50 meters away from the first bank in the United States, the one that Alexander Hamilton started. We combined that asset with around 20 Bitcoin. And we provided a loan to refinance the existing mortgage on the property, to provide the asset sponsor some funding for capital improvements, and with the remainder to buy the 20 Bitcoin.
Okay, we got to go backwards.
Go ahead.
You got to go backwards. We're just going to slow the whole thing down so everybody understands what happened. Okay, so there's a property.
Yep.
Physical property.
Multifamily. Right? Multifamily. 63 units.
It's a multifamily property. The sponsor, effectively the owner of that property, needs a loan.
That's right.
Okay, they come to you.
That's right.
Okay, you say, we'll provide you the loan in the form of?
A loan.
A classic loan.
That's right.
Okay, so you're going to give them cash.
That's right. Term financing.
Term financing. And how long is the loan? Just
10 years.
10-year loan. Okay.
That's right.
It's above market rate or below, or what's
no market rate interest rate?
I'm just trying to slow the whole thing. Okay, now let's introduce the Bitcoin piece into it.
That's right.
So no, explain how the Bitcoin piece can relate. So the loan has been provided.
The use of proceeds is to pay off the existing financing. So
the use of the proceeds
of the loan is to retire the existing mortgage.
Right. So there's an old mortgage.
Gone.
They're going to pay the old mortgage off.
It's been paid off.
Okay.
Now they have a little bit extra money to make some improvements in the property.
Right. So a little bit extra cash. So the amount of money you've lent pays off the old loan.
That's right.
It's also you have a little bit extra to fix stuff
the
up.
Property, fix stuff up.
Yep.
And then with the remainder, which is a little bit more.
Even a little extra.
That's right.
Turn.
And that, instead of cash out, Bitcoin in. And we use it to purchase some Bitcoin and add it to the collateral package of the loan. So now our loan is supported by both the traditional asset, the 63-unit apartment building, and the Bitcoin.
Okay. So the loan, it was maybe $2 million more, so that's how you get the Bitcoin out?
Exactly right. So it's
on the assumption that the Bitcoin's going to rise faster, and that will become an asset.
Over the life of the loan, for sure. So we think on the downside, this provides us with much better protection compared to a traditional lender, because a traditional lender, if something goes wrong, they have to recover against that particular building, which is idiosyncratic risk. Something might happen with the maintenance or what have you.
But that also requires conviction on your end that Bitcoin is not a volatile asset over time. And that is either going to go up or at least stay where it is.
Well, that's by fusing the Bitcoin with credit and by fusing it with traditionally financeable assets, it gives us the luxury of expressing that medium-term view on Bitcoin. And that's what's key. It's volatile in the short run. Minute by minute today, who knows? It could cross 100,000. That would be exciting.
How long's the loan?
10 years.
10 years.
And the minimum hold period for the Bitcoin is 4 years. So what we say to the borrower is we say, look, you can repay the loan at any time for any reason with no penalty, which is a really valuable feature compared to a traditional loan.
Yeah, that's like a home mortgage. Then.
Like a home mortgage almost. That's very unusual for commercial financing. But what we do say is that to the extent that the loan is repaid at year 4 or earlier, the minimum will release the property. But the minimum length of time that the Bitcoin has to stay in escrow is 4 years.
Andrew, go on to, because I don't know how much time we have, but I'm fascinated about, there is a problem for state and municipalities in terms of the asset liability mix. Somehow you think that using Bitcoin, that you can lower that risk and increase returns and narrow the gap. How does that work for pensions?
Well, if you think about it, Joe, the average exposure to fixed income at U.S. pensions is around 25 to 30%.
Okay.
And many of them have an asset liability funding mismatch of around 25% as well. They're a big shortfall. It's going to be a big burden on taxpayers and a real problem.
We've talked about this so much and how to solve it.
Now, what they've been doing in credit is reaching for risk, going for super high yields, leverage, niche strategies. And I think that it's time to pivot away from those toward high quality credit, where the return per unit of risk is extremely attractive, but the returns are not as high. How do you compensate for that? You fuse the credit with Bitcoin, and you utilize the credit to express a medium to long-term duration. Because yes, if you have the Bitcoin for 1 day, 1 week, it's extremely volatile. But for 4 years, 4-year hold period, the worst ever return has been just over 23%. The 5th percentile, 30%. The 50th percentile, 91%. So if you take a small amount of Bitcoin and you add it to a large amount of high-quality credit in novel lending solutions, novel structured credit pairings, what you can accomplish from an asset allocation and an overall portfolio strategy perspective is incredible. It can actually be a cornerstone to close the asset liability gap at pensions.
Absolutely. Oh yeah, I thought I closed the stream there. Absolutely brilliant. That's what my dad said when I sent that video to him. My dad, not a huge Bitcoiner, owned some Bitcoin, worked in the bank for 40 years, lending. Said absolutely brilliant. So let's walk through this, because I know there's a lot of stuff to take in. So I figured I would just make a little spreadsheet here for the folks, see what's exactly going on here, see what outcome might be. I think this is kind of just the average of most people out there. I mean, this isn't for everybody. If you just bought a house like last year, you probably don't have any sort of equity in the house. So this probably won't apply to you. But if you're somebody who's like owned a house for 5-10 years, you paid a decent amount off the mortgage, this is definitely something that you should be looking into. So you can see here, this is a normal house value, $500,000. After 10 years, probably, this might be a little bit higher, maybe 15 years, but you got $200,000 left on the mortgage. So you got $300,000 equity in the house. So the proceeds, you go to this guy who was just on CNBC there, you say, okay, here's what I got. So they give you $500,000 for the value of the house. It's your proceeds. So this is how much you pay to the bank. That's left over on the mortgage there, $200,000. So you're left with $300,000. So as they talked about there, he said that they allocate a little bit to improvements for the house. So I used, what is this, 1/6, $50,000. Maybe update the bathrooms, the kitchen. I mean, you can't do a whole lot with $50,000 anymore. But this also bumps up the value of the house. Improvements, capital improvements. So you put 50 grand into that. The wife's happy. And you put the rest into Bitcoin. And so in this case, you're going to end up current day, 2.5 Bitcoin. So I did a couple different scenarios here based on the previous cycles of Bitcoin. This is not guaranteed. This is just using past metrics. But keep in mind here that the last time we had a halving cycle, we did not have Wall Street. We did not have countries buying Bitcoin. We did not have public companies buying Bitcoin. So last time Bitcoin went from 5,000 to 65,000, 11x. So I used 5 here just as a very, very conservative amount. So the current price of Bitcoin, $98,000, we're going to expect it to be 5x at the bare minimum. So that puts us at 490 per Bitcoin. No, sorry. Is that right? I didn't even do this properly. That's based on 1 Bitcoin. So this gets even crazier then. I'll leave it at this, just for the sake of doing it. I might go back after and revise this, but this is based on 1 Bitcoin. So you actually get 2.5 Bitcoin here. So and then I used 15x. I think that that's doable. I do, really. A lot of people laugh at that, but we did 11x last cycle before, again, any of those entities showed up. So 15. So that puts at 1.4 million per Bitcoin. So this is what it looks like afterwards. This is at the 5x multiplier if Bitcoin goes up 5x. So you got 490K. That's your one asset, your Bitcoin. Your house value, you put $50,000 into it. It probably appreciated as well. This is probably low, but you got 550. So your total asset value is now $1.04 million. Less the mortgage because you had to pay them, or you still owe them the $500,000. So your net worth increased by $540,000. This is at the 15x. So this is Bitcoin at 15x. You got $1.47 million worth of Bitcoin. You got the same house, 550,000. And so your total assets now are worth $2.02 million. You got to pay up the mortgage though. You still owe the company $500,000, and your net worth increased $1.5 million. So somewhere between these is probably accurate. I mean, if we use I didn't do this properly. So if we take here, instead of the 490, we times that by 2.5, which is how many Bitcoin you had. So you're still even at a 5x this cycle, and you're holding this for 10 years. So this could be even higher than this. So your Bitcoin's worth $1.2 million at a 5x multiplier. It goes up 5x. Your house is 550. Your total assets are 1.7 million. You owe 500,000, and your net worth has increased $1.2 million. Couple things there. They said that they're going to have to hold on to the Bitcoin for 4 years minimum, which makes perfect sense, because as you said there, anybody who's held on to their Bitcoin for at least 4 years has made a minimum of 20% on that Bitcoin. The loan is 10 years. You can repay it at any time, no fees, which is unbelievable. And it just makes so much sense for the consumer and for the lender. Like, this is just the beginning of this whole thing, right? And so again, who is this for? I would say this is for somebody who has a decent amount of equity built up in their house. So if you've owned the house for 5-10 years, or if you are completely paid off your house. Like, there's a lot of people out there watching this. They're like, okay, well, I don't want to refinance the whole mortgage, but maybe we can take half it out, buy some Bitcoin, recollateralize the loan, get a new mortgage, very low rates over 10 years. And then you don't have to take any of your other investments or your cash or your spending money. If you're living off of your whatever you have, you don't have to mess with that. You can just refinance your house. Who this is not for, anybody who's who's owned the house for like a year and they hardly have any equity. This would be a waste of time probably to do. So if I was in the US, I would definitely do this. I'm pretty sure that the company's only dealing with US people, but I think it is going to be a conversation to have with the bank and see if they'll do something similar. I don't expect that they'll do the no fees if we want to repay it. But, you look at that and you're like, okay, well, I mean, even in 10 years, let's say that that's off 5%. In 10 years from now, Bitcoin could be 50x from here. So you pay off your mortgage with money you took out in your mortgage to buy Bitcoin. I mean, there's things like this. This is what's going to change everything. And this is what's going to absolutely destroy the old system, is stuff like this, because it just makes too much sense. It makes too much sense. And the banks that are going to be the last to adopt this are going to be the ones who miss out on all this opportunity here. So that was the main thing I wanted to talk about today. I wanted to do a video talking about it and just post it, but I decided to do it live here. And I'm interested to see what you guys think. If there's any risks there, I mean, other than Bitcoin going down, But at the same time, you also have to consider that even if Bitcoin went down, the worst thing that's going to happen there is you're just going to have to pay off your mortgage, pay more into your mortgage because you already had equity built up. Let's say Bitcoin crashes. You just have to spend more years paying off your mortgage. That's worst case, right? And I love this strategy compared to something like taking on credit card debt or other things that people are trying to do to get Bitcoin right now. I think that that's an absolute no-brainer strategy for anybody who has equity in a house.